Hi, this is Jason Toll. Welcome to another segment of the Toll Land Development blog. Today we're at the offices of Witham and we're with Peter Lara. Peter is the tax services partner here at the firm, and we'll be talking about tax planning for the long-term landowner. We'll be talking about issues that affect those individuals that have owned land for a long period, let's say 10 plus, 20 plus years, and now they're at a point in their life where they're deciding what to do with their land and they're thinking about the tax ramifications. And as it turns out, this is Peter's specialty, among really a few other things, I would think. So tell us, Peter, tell us about yourself. What is your specialty? What do you do here at the firm, and how do you help your clients?
Well, I ask myself every day what I do here. I'm just kidding. I'm an accountant, so sometimes not the most exciting thing in the world, but it is exciting when we talk about taxes and generally how to lower people's liability and exposure in the IRS. So primarily, I am responsible for servicing clients, both in the real estate, construction, and professional services area. I've been doing this for over 25 years. I started my career after I graduated from UCF with Arthur Anderson. So that's quite a while ago. Worked for Pricewaterhouse out of Florida, a little bit of time in San Francisco, California, and then have been here ever since. Primarily working with middle market companies, closely held companies with owners trying to do the best we can to make sure they pay their fair share of tax and only their fair share of tax.
Okay, I like the way that sounds. That's great. Well, let's get started. We're going to talk about really three different issues, and the first one is let's say we have a property owner who is at a certain phase of their life and they're thinking that they're ready to dispose of their real estate assets, and their idea is to use those proceeds to go on to the next phase of their life. They're going to spend the money, essentially. They're going to spend the money. How would you advise a client to handle the proceeds of a sale with that in mind?
Yeah. We talked about this a little bit. It all depends, how much that land is worth, how long they've held it for, and really what they want to do. I think the most basic thing that you can think about is they've held the land for quite a bit of time. They paid very little for it. Now the fair market value is 10 times what they paid for it. They might be a developer or someone who's really interested in it, and they can actually cash out. The simplest thing they can do is just sell it and pay tax on the gain. Right now, capital tax gains rate are very favorable, about 20%. If it's land that you've held for investment purposes, you might have to pay the additional 3.8% tax, which is the net investment income tax. So even though 23.8% more or less of your gross proceeds, or the proceeds less whatever the basis is, seems kind of high, the environment right now is right to be able to do that because of those favorable rates. We don't know what's going to happen in the next year or so, but that would be one option. Of course, then you need to take those funds and make sure they're invested properly, and then have a plan as to how you're going to utilize those funds over the years and how you're going to enjoy it.
So you bring up a good point. We don't know what's going to happen in the next year or so, and right now we're in 2021. This is May of 2021, and there's a lot of uncertainty. So I think the best thing to do is to always check with your tax professional.
That is correct.
Always.
That is
Right.
correct.
Okay, the second scenario is we have a long-term property owner who wishes to sell their real estate, and they either have sufficient tax planning in place, estate planning, or they need estate planning, and they're thinking about the liability of transferring the proceeds onto their descendants. How will the next generation handle that money? And so how would you, it's a very broad question, but in general, how would you advise a client to approach a situation like that?
Yeah, that is a broad question, and it really has to do with what their desire is to help the next generation along, of course. So I think the first thing that I think that individual will need to sit down and figure out is, if I have enough liquidity or have enough investments, or I'm doing okay, and I would like to transfer this asset to some of my children or their descendants, how much would I like to transfer? What is the purpose of that, and what are they going to do with it? I think would be one important thing. The other thing, from a purely tax perspective that you have to think about it's really what gifting that individual has done during their lifetime and how much of the exemption they have left.
Okay.
You know, obviously, the gifting scenario is also very favorable this year so far, and it has been favorable. An individual, I believe, can give about 11.5 million or 11.66 million away without incurring any gift tax liability. And that would be one member of a couple. It would be the husband. The wife can bring that together, so it's over $20 million that can be gifted. So I think the first thing is that gifting and the planning that you're going to do. You know, second is understanding that once you transfer that piece of property from a gift tax perspective, if it has a very low tax basis, you are shifting that capital gain or that tax obligation to the recipient, right? So once you can realize that that's going to be the tax impact of doing that, that will be helpful. Also, I think you have to plan and think about overall how many assets you have and how much you want to get out of your estate currently. Again, you mentioned briefly that the environment may be changing. There's been a lot of talks about taking that $11.5 million exemption all the way down to maybe $3 million or $3.5 million starting next year or possibly this year. So I think that's one issue that if you really want to figure out the best and most efficient way and when you need to do it, you need to start planning for it now.
I've said it before and I will say it again,
Yeah.
that competent tax advisory, having a competent tax advisor on your side will be crucial,
Yeah.
especially coming up.
Yeah. Another thing that people often miss is not the gifting part or the estate part, but also the charitable giving. There are certain vehicles, trust vehicles, that if you have highly appreciated land, you can give a charitable contribution based on a certain factor to a trust. That trust can turn around and sell that piece of property tax-free. It can guarantee you a return of your funds over a period of time, and then when you pass away, the remaining funds go to the charity that you have selected. So there are various ways not only to do estate planning, but also charitable giving that will allow you to have some income stream over a period of time and then help whatever charity you choose after a certain amount.
I like to think that there's plenty of people out there who have these charitable giving plans, and this could be a terrific benefit to them.
It is.
Thanks for bringing that up.
Yeah.
Okay.
Perfect.
Let's come to the last scenario, and we're going to talk about a 1031 exchange. Most people know what a 1031 exchange, but not everyone knows what this is. Briefly, let's go into the basics of a 1031 exchange and what are the benefits of such a vehicle.
So the benefits is that you can defer the gain that you would realize if you straight out sold the property. So for example, you have a piece of land that 20 years ago you bought for $150,000. It's been sitting there vacant, and now that piece of land is worth $2 million. You have a substantial gain between the $150,000 and the $2 million you could sell it for. But let's say that at this moment you're not ready, or you're not really ready to cash out. You don't need the cash, and you like to defer the taxes on it. You can enter in an exchange where you sell that piece of property and you exchange it for a property that is equivalent in value or greater. And right now, a 1031 can be any type of real property. So you can exchange land for a commercial building, for residential rental, anything that generates income.
It's funny, the term is like-kind exchange, but really, there's not a lot that's similar to let's say, a piece of agricultural land and a residential investment property.
That is correct.
There's nothing similar, but yet it still qualifies.
That's right. Yeah, the real estate laws are very specific, and the real estate umbrella or the real property is very broad.
Right.
Years ago, the like-kind was very important because like-kind exchanges didn't only apply to real property, which is land, buildings, or any commercial property. It also applied to tangible assets. So you can exchange one plane for another, or a car for another, as long as it was held for business use. But of course, that went away several years ago, and now the like-kind, which you, as you say, doesn't really mean that the properties are like-kind, but the type of investment, real property, is under the like-kind umbrella.
Okay.
You're correct.
That makes sense. And what happens in a scenario where there's a 1031 exchange and the property owner, let's say, passes, and there's now a basis? What happens to the basis in that property? The gain that's been that's been deferred.
Mhm.
What happens to that?
Well, that's an interesting question. So let's take a scenario. For example, if that were to occur, when someone were to pass away and that person has that property in their hands, there's something called a step up in basis, which means that deferred gain, which is deferred until you sell that replacement property, basically goes away, and you get a step up in basis, and you're able to now fully realize the cash out for it without incurring a significant gain.
So what you're saying is that deferred gain is no longer a liability.
That's right.
Wow. If that's not an estate plan, I don't know what is, right?
That's right.
Yeah,
right.
very interesting. So, there's many things to think about as you consider the disposition of real estate, and Peter is well positioned to advise on these subjects. And you know what? I appreciate you spending just a short time with us. There's much more on this, I'm sure, and Peter can help you. What we'll do is we'll have your contact information splashed across the screen here in this segment. We'll have it also in the beginning, and please contact Peter, and he would like nothing more than to help you.
Sure, we're here to help. There's a lot of complexity. Various things are moving. Various moving parts in a real estate transaction. I think if you sit down and you have a comprehensive plan, you think about what you want to accomplish, and you think about it carefully, and you quantify it. You put pen to paper. You're able to get to the goals that you want to get to, whether charitable, you want to gift to your kids or to your family members. If you want to sell or you want to reinvest into an asset that now generates some income versus a piece of land that isn't generating income at the moment.
Okay. With that said, we're going to conclude this segment of the Toll Land vlog, and I want to thank you for watching, and we'll see you next time.
Thank you.
Goodbye.